All right, we are live, and this is you know the rest. What the F? WTF going live on this beautiful Wednesday morning. And you know what? In wintertime, you don't say that very often out here in Buffalo, New York, but it is gorgeous. And today, we're going to talk about the mess, the giant mess that is forming in the markets, the mess that's forming on the news, the divide, the nonsense. We're going to hit it all. We're going to talk about how this is shaping up to look a lot like the early 2000s, which, as you all know, was the dot-com crash. We're going to do some comparisons with Sun Micro. Many of you probably don't even remember Sun Micro, but what you will find out today is you'll find out how Sun Micro was the shining star, the almighty, the grand puppet, if you will, of the stock market back then. And you'll see the multiples it was trading at and how that is actually measured. And then we're going to compare that to some of the companies that you think are the shining stars, the grand puppets, the whatever you want to call them in today's market. And you're probably going to look at it and be like, no freaking way. Stephen, you got a bunch of stuff you're going to be covering as well. What are some of the highlights you want to hit today?
Hey, man, always something going on in the news these days, that's for sure. So it looks like Trump and Doge, Elon Musk continue to just wreck shop and see if they can take the hammer. Kevin O'Leary says it's not enough. We need to whack harder. And everybody's opinions are coming out. We got the talking heads on TV. We got the podcast Tech Bros on their podcast talking about their opinions. You know, everybody's got their own opinion. We all know what opinions are like. And kind of like Chris said with what the F, you guys can finish that sentence. But a lot going on, that's for sure. We'll pull up some wacky stories. We'll get into, are we headed towards a recession? What are these tariffs really doing? And kind of rock and roll from there, Chris. I think it's going to be a good show today, though.
Or are we already in a recession and we just don't know? We'll be right back after this. All right, so we're gonna kick this off, and we're just gonna dive right in because we've only got an hour with all of you for WTF, and we got some new folks coming in. I'm seeing some new names popping in here from YouTube, but we stream every week at 9:30 Eastern. We do it on YouTube, on Facebook, and also all of our friends popping in from Instagram. So this show is growing, and it's going to just keep getting bigger and bigger. Basically, this show started out as where we would rant, rave, and argue about what's in the news, but it has taken on a new shape because the news, well, if any of you are watching CNN, what are you actually getting from that outside of a bunch of bumbling mess and just nothing good has come out of me watching CNN. Nothing good has really come out of me watching any news stations for that matter. So what I've done is I've turned my attention to white papers, economic newsletters, and all the stuff that you have to pay to get. Why? Well, because you get the truth and you get different opinions, and you're going to get them telling you not what the news wants them to say. Kudos to O'Leary, who just goes headfirst into the mess. And we're going to maybe play a video on that, but it's just, oh my God, I can't even listen to it. But we're going to dive into what I think and what Stephen would agree with is at least the closest resemblance of the truth about what's really happening. Stephen, you want to kick us off, and where do we start?
Oh, man. I mean, I think we kind of just go ahead and hit the elephant in the room. Everybody's talking. What's going on with the stock market?
All right. Well, let's do that. And here, I'm going to share my screen, Stephen. We're going to come over and we're going to look at what is going on in the stock market. I've done a bunch of prep here, and I'm going to start off with the shining star in the tech industry, the almighty. Everybody, I can't tell you how many times I've heard clients or they're usually potential clients because they think they know everything. And I'm not going to single out anybody, but NVIDIA. I know you've made a bunch of money with that company, and I know it's a great company, and I know it's going to be maybe around in the future, but why is this the almighty? Apple, NVIDIA. So we're going to start out looking at what does that particular stock look like. All right, so here we go. So Now, what I've got here, and I'm going to do this on a couple. I'm going to do it broad-based. We're going to talk about the S&P 500, the 500 largest stocks. But I just want you to kind of take a peek at this right here, okay? What I did is I went in here, and just so you know some of the metrics, this is looking at, what did I do, a 5-year? Let's see, we got from 2022 straight to current. And what we're going to do is we're going to look at how fast this stock has gone up, okay? I just want, 3 years, 1 week chart. Now, I know there's a lot of stuff on here you don't need to know, don't care about the moving averages and everything, but moving averages, and I track a lot of them, okay, track many different moving averages. But if you look at these like purple lines, you can see like this sucker was just moving up and up and up and up and up and up, and it hit its all-time high right about there, about $1.53. Today, it's trading at 115. Okay, so we're trading at 115. And that's actually up almost 7% for the market today. So the market just opened, we're up 7%. So this is actually pretty good. And you can see that right over here, how we're kind of making a comeback, but we're not making a comeback. We're just seeing a little intraday rally. So the thing I want to, again, go back to is let's look at where the high was. Okay. And I've been telling people, take your gains off the table and let's go down to 115. The stock has moved 35%. Okay, so you've seen a drop of 35%. So if you do that, so let's see, $35, not 35%. So if you do 35 and we divide that into, what was that, 150, I'm just trying to kind of give you guys some metrics. That's about a 23% fall. So we've already come down 23%, but that's not the real story. Okay, so if you learn how to chart stocks, and you learn how to understand floors and ceilings, which are called support and resistance, but I try to keep everything simple. I've kind of done that with some of these blue lines, and I didn't really spend a ton of time. You can spend all day long doing this, but who's got the time? I certainly don't. This right here is a pretty good floor that I think we're going to stop at. But you can see it's funny because it's just bouncing almost right off of that floor, and I could move this sucker up a little bit, but $95, okay? That's about where I feel you've got a good floor, but $95 to right around $100 is probably a good floor. Now, here's the question you got to ask yourself. Do we think there's enough energy in the market, enough buyers, enough enthusiasm, enough FOMO to take this thing and bounce it off the floor, which we're not far off of, bounce it off the floor and run it back up to somewhere in this range of 130 to 150, okay? Because that's pretty strong up around that area. About 136 to 150, you got a pretty good ceiling right there. Can we run up to that? Or everything you're seeing in the news, everything you're hearing about, everything you're watching, and everything we've been talking about, is it more likely that we go from the floor of right around, we'll call it $100, okay, just to keep it simple, from $100, is it more likely that we run down to this floor? Because there really is no other stopping places. How I see it, from where we're almost at, we're about $16 as of today, which we're up $7, $16 away from what I would say would be the cliff. Okay, the cliff. And that cliff probably would run you from about $100, give or take, all the way down to this little blue line of right around $50. I see no other stopping points. None. I literally, there's none, because the stock went up so fast that that's the only outcome. But hold on. Let's just look at SPY. Now, I know, some of you are probably bored at looking at this, but this stuff's really important to try to understand. So I can kind of give you a 5-year look. So this is the SPY 5-year, but I'm going to use the 3-year just because we don't want to get too crazy. Actually, let me show you one other thing, because we can do a 15-year. Does everybody see that little bugger right there? Look at how fast and how steep that line went up. This is just the S&P 500, but remember, the S&P 500 is literally dominated by roughly about 10 stocks. Tesla is one of them. How's Tesla been doing? NVIDIA is one of those. Apple, Microsoft. Know some of those names? All right, so let's come back down to the 3-year. And what I want to do is exactly what I showed you before. Moving averages. So the one thing with the moving averages, they move really slow, depending on which one you're looking at. And I'm looking at real slow movers. But if I were to kind of heighten this thing and I was to look at a 1-year chart, what way is the moving average going? Is it going sideways or is it going down? Well, I know that might be hard to see on your screen, but I'll tell you right now, on every stock I looked at, every index I looked at, The moving averages are all turning down. And folks, that ain't good. But let's get back to reality. And what I want to show you here is the probability of where we're looking to go. So how you do that is you just draw a couple lines, right? So we got to get, where's my line tool? There we go, drawing tools. So we need a trend line. And all I'm going to do, and I'm not going to waste too much more time, but I just want to show you, like, if our high point in the S&P was 613, see that number right there? 613 was our high point. Okay, and where are we at today? About 561. So you can see it's fallen quite a bit. And some people are like, oh, wow, it's not going to go down anymore. Well, actually, it doesn't really appear to be doing all that well today. It's up 1%, which is actually not too bad. But where's the likeliness of this thing going? So I would say we are real. Now, you've heard this in the news, and this is what I'm trying to show you. We're real close to a correction territory. So I'll draw a line right here. Okay. And we are today bouncing off that line, that floor. That's the correction zone. And all the correction zone means is this is about where we're going to start to correct. And where the market's got to make a decision, is it going to bounce and go up to previous highs, or is it more likely that it's going to fall? And if it falls, where's it going to go? Well, when I start drawing lines, this isn't even a very good one, but whoops, I don't want to buy. The only thing I've been doing is shorting. All right, so if we're going to stop anywhere, let me just draw a line here. What do we got? What's that magic number? 520. Okay, now and we're going to go deeper into this, but 520. So right now, today, we're at 561 on a little bounce, minus 520, and I don't even think this is a really strong floor. That's $41. 41 divided by, let's just do today's price. You're looking at another 7%. Okay, so look at your portfolio. Look at your glorious IULs, if you have any. Hopefully nobody on here has any of those things. They're all tied to some type of an index. And remember, yes, you've got a floor, but that doesn't change your cost of insurance. There's so much emphasis and so much money and things factored into these indexes that literally they're going to let loose. I don't think that's the stopping place. I truly don't. I literally would argue that the stronger stopping place is probably somewhere down around this range. Okay, so let me draw a line. And how I know that is you just start drawing lines and see how many times we're touching where the stock is or where this index has been there. Here, all sorts of activity down here. This was all in 2022, 2023, before the son of a pup took off because they printed $5.2 trillion. And a lot of that money went into risky assets, being the S&P 500, because every guru is out there telling you, put money in the S&P 500. This is a likely number. And I'm going to show you in a second how all the economists are saying we're probably looking at between a 50 and 90% fallout. Well, that would about do it, wouldn't it? 613 from the high down to around 400. Do the math. That's probably about where they're getting their numbers from. It's not hard to look at this stuff. So I'm going to stop sharing that because I know all of you are bored, but I could do this all day long and show you every single stock. But here's a couple other things that I think are worthy of talking about. Right now, this economist right here, and I'm just going to share this. I'm trying to build to the conclusion of where I don't guess on this stuff, folks. I'm not just making this stuff up. I'm showing you all the stuff I read. I pay to listen or to get these articles. I got about 6 or 7 economists, okay, and hedge fund managers and various different people that feed into it. So this is the one I think that is most interesting. Now, pay attention to this because this is really important. Sun Microsystems. How many of you remember Sun Microsystems? Put it in the chat. Just put I. Remember Sun Microsystems. Huge company. How big? Well, let's come down here. Shares soared from $5 to $64 at the peak in 2000. The company's market cap reached $200 billion. That was huge. Okay. That is a price to sales ratio of 10x. Okay. Company's market cap and its revenues means higher than expenses. Okay. So let's put that into perspective. And I love how he did this. So in 2002, Sun Microsystems shares crashed 90%. 90%. But let's dive a little deeper into that. So right here, this is talking about this. There's a letter that was put out. Dear Mr. Shareholder, Scott McNealy, okay, who was the CEO at that time. McNealy chastised investors for running Sun stock prices up to such ridiculous levels. So basically, The CEO is saying it's the stockholders' faults. It's all you investors. You ran the price up, and institutions at that. Specifically, he singled out the 10x price to sales number and explained exactly what such a valuation implies. I'm reading right off of this. So a 10x price to sales numbers. Now, you don't have any relevance to what that means. So just put a pin in that. But here's what that would mean. At 10x times revenue, to give you a 10-year payback, in other words, if we're going to pay back that money in 10 years, I have to pay you 100% of the revenues for 10 straight years in dividends. That assumes that I have zero cost of goods sold, and it's very hard for a computer company to have zero costs, right? So to assume zero expenses, which is really hard with 39,000 employees. How many people work for Sun Microsystems today? I don't know, but do the research. It ain't 39,000. That assumes I pay no taxes. Pretty hard to do that. It assumes I pay no taxes on your dividends. Pretty hard to do that. That's illegal. And that assumes zero R&D. Now that we've done that, and basically, let me kind of go a little bit forward here. So eventually Sun Microsystems was acquired by Oracle at $9.40 a share. Quite the bargain. Okay. And that was down 85%. So, that was a bottom feeder buying it. You can see here's the bubblier 2000s. Okay. So this isn't 2000. This is 2000 over here. This is today. This is the market today. Okay. Now let's just come down, and there was something else. I got to find it here where it talks about today. Indexes. All right. Right here. After the recent pullback, and this is just a few days old, this article, after the recent pullback, the index is trading at roughly 8 to 9x sales. So remember, I just told you what Sun Microsystems CEO said 10x looked like. And now what they're looking at, they're just looking at the index, and the index is trading only at 8x or 9x, pretty close to that 10x. So is the market overpriced? It's beyond overpriced. It's beyond overvalued. Palantir, okay, right there, trades at 69 times price to sales ratio. Gosh, we could look at all the companies. We could just see where they're all trading, but they're all going to be about the same. That's 7 times higher than Sun Microsystems. Okay. Are you seeing what we're putting up, or seeing what we're talking about here? So then he gives a warning. He's basically just saying markets are at all-time highs based on every single available metric. PE ratios, cap ratios, market cap, GDP ratios, concentration risk. I mean, all the metrics that an economist would look at, they're all trading at all-time highs. But yet people are still putting money in the markets. People are still out there, not going to mention any names. Stephen, you know who I'm talking about, telling people this is a buying opportunity, that this dip is a buying opportunity. Are you out of your freaking mind? We haven't even corrected yet. We're just getting to correction zone. Yes, look at your 401ks. I had somebody the other day say, "Oh, I lost 100,000 in my 401k." I said it wasn't from the person, but I said, "Yeah, because you don't fucking listen. Because you think everything's just going to keep going up because you're just blind and you're not looking at the important things." I have been sounding the warning bells. We have been sounding the warning bells for far too long. I don't feel bad for anybody if you're losing your ass right now, and you're going to lose a lot more if you don't wake up and start looking at the things you need to look at. And when you start telling us, when we get on calls, "Oh, I lost 100,000, I lost 200,000, I lost 20%, I lost 30%. Where have you been? Who are you getting information from? Oh, your financial advisor. They told you that's just a paper loss. No big deal. Yeah, great. How does that feel? You feel good about your advisor's recommendations? You feel good? You should just put more money in because this is a buying opportunity, right? Okay, we'll see how that plays out. I'm just telling you that these people that I'm reading articles from, this information, these warning signs trump every financial advisor you will ever talk to, because the advisor doesn't even hold any of this information, because this is not how they're trained. They are salespeople, folks. They are trained to teach. They are trained to sell. That's what they're trained to do. They need to be playing defense right now, but so many of them, not all of them, but so many of them, unfortunately, are playing offense still. This is not an offensive game. This is a defensive game right now. It has been a defensive game, yet too many people are on the offensive side, and it's costing them maybe their retirement, or it's going to cost their family. It's going to cost their lifestyle. It's going to cost them a lot more than just sitting on this, or a lot more than just, "Oh, it's just a paper loss." I've seen this, folks. I've seen how this unfolds, and you don't want to be part of it. You don't want to be part of it. I don't know how else to put it to you, but let me put it to you this way. Let's look at what's really going on. Frontline. Okay, we're going to talk frontline news. Here we go. Right here, auto delinquencies. What's going on? Have you been paying attention to delinquencies? Because we have. I've done a lot of YouTube videos on that, but here's one. How about autos? There was a massive boom in auto purchases during the pandemic and after the pandemic. I mean, look at what car prices were doing. They're falling off the face of the earth. Now, I just was talking to, Larissa's dad today. His transmission went in a Nissan, surprise, surprise, but he went to Enterprise Auto Sales and bought a new 2020, not brand new, but 2024 used Altima. And he told me how much he paid for it. I'm like, holy crap, that car would have been $10,000 more 2 years ago. But here's the problem. You want to look at Frontline. You want to know what's really going on. You want to see where we're really going. Look at delinquencies. Okay. Here was the great financial recess. These lines, these peaks are delinquencies. Okay. Here's us today. Do you see where that line is? See where my little cursor is? That's where we're at today. That's where we're at today. The second surge was larger than early 2006 and mid 2009. So he's basically just saying this time around, auto loan delinquencies are very likely to get well over 4% and likely as high as 5% plus, much higher than that of 2008's crisis at 3.5%. That means unemployment rates should get well over the 10% rate reached in 2009. But it's just one economist's opinion. Well, we could keep going more. Hold on. Let's not look at an economist opinion. Let's look at the government. What is the government showing you about delinquencies? Well, how about this one right here? And I'm just going to go rapid fire. We're not going to spend a lot of time. I'm just trying to get you to see what's going on. Here you go. Here's credit card loan delinquencies. So here was the peak. That was the pandemic. People were paying credit cards down. Look at how awesome that was. During the pandemic, I think one of the greatest things that came out of it, which there wasn't much good, was people were saving money. And when they were saving money, they were paying down debt. But then all the money printing came. And the world opened back up and you got to take your masks off. And look what happened. Credit card debt soared. But you know what's a telltale sign of people being fearful? Credit card debt going down. Now look what's happening. We're starting to see this trend down. Wonder why? Why would we start seeing the trend going down? People are spending less money. They're going out to eat less. They're traveling less. You don't believe me about that? Look at Delta's new sales guidance and forecast. Look at Southwest's new sales guidance and forecast in the future. Slow, folks. Slow. They're going down. That is the best leading indicator you can look at is airlines, because you know what? Very quickly, people stop traveling when they don't have the money. And what are they doing right here? They're showing you. Credit cards are getting paid down. I like to think, Stephen, that we're a little bit of a part of that because we got great ways to show people how to pay it down. But hold on, let's keep going on. You know what one of the biggest bubbles that we're going to see and is already happening? Commercial loans. Commercial loans. Okay, right here. Commercial real estate loans. You don't hear about these much anymore, do you? These things are going off the cliff. Here's delinquencies of commercial loans. Whoa. What in the hell is going on there? Oh, could it be because everybody decided to go home and work and stay at home working, that there was no need for office buildings and office space? And a lot of those leases are coming due and they don't renew them. So there's a lot of vacant buildings. So a lot of these big land owners and these big real estate owners, they're falling behind. Oh, and you know what else happened? A lot of their loans reset at much higher interest rates than where they were during the pandemic or after the pandemic, because interest rates had to go up, right? The Fed had to curb the monster that they created, inflation. Wow. What's the impact? Defaults are next, folks. These are just delinquencies. These are just delinquencies. These are not defaults.
I don't see the screen, Chris, if you're sharing.
Damn it. I'm so into that. But there you go. Look at that. Look at that. That's commercial loan delinquencies. Defaults are next. This excludes farmland. Okay. Hold on. I got one more, and we're going to turn this over. Let's see. That was commercial. Here we go. Mortgage. How about mortgages? I mean, come on. What's a telltale sign of mortgages? Or a telltale sign of slowdowns? People hitting, a tough time. Mortgages? They stop paying the mortgage? Here we go. FHA and conventional. Look at these numbers. Look at these numbers. Delinquency rates are starting to go up, but, not much. More on that later. All right. Well, I'm done with my little rant, Stephen. So let's take it to somewhere else and let's see what else is going on out there. Hopefully that wakes some folks up and gets you to ask second questions to your advisor. And hey, actually, I got some good news for you. Here's what we're doing. Pretty soon, PMC Wealth is going to be available to each and every one of you. And what PMC Wealth is something brand new. It's a registered investment advisory that is set up on a retainer basis. So you can retain PMC Wealth advisors to literally just look at your current investments that you have, your current financial advisors' investments, to give you a second opinion. You can just retain us for a month, 2 months, 3 months, all sorts of things. But you'll be hearing more about that soon, because a lot of people, you know what you need? A second real opinion for someone that's not trying to take your assets over, someone that's not trying to get you to move all your assets over to them. Sometimes you just need somebody to see, is your financial advisor getting a little lazy, lackluster, missing some things, maybe a little busy on the golf course, can't look at your stuff. Oh, golf game. Hey, come on. We got to get there by noon. I'm sorry, I don't mean to call this out. And there are a lot of very good advisors, but sometimes you just got to open a can of whoop ass on these folks and wake them up. But you know what? The only way they get woken up is when their clients start asking hard questions and really putting them on the spot. Stephen, take it from there.
Yeah, no, I mean, some interesting watching the markets move right now, because there's some good positive news coming out this morning on CPI data from February. So just recently released a few minutes ago. Inflation rate eased to 2.8% in February, less than expected. So consumer price index for both all items and core inflation increased 0.2% in February, slightly below expectations. So on an annual basis, headline inflation is at 2.8%, while core is at 3.1. Both were 0.1% below what the Wall Street consensus was and what previous months levels. So that's good news for the economy. But
it is. But Stephen, hold on a second. Developing news right now. Even with that really positive news, the Dow Jones just turned negative right now. We're down 133 on the Dow. It's just not enough. Keep going.
Yeah, that's what I'm saying. I'm watching the market move right now, and it's headed in the wrong direction. I mean, we're seeing some good stuff come out. I mean, right here, weekly mortgage demand surges 11% higher as interest rates drop for the 6th straight week. On top of that, just yesterday, the House narrowly passed, but it did pass the 6-month funding bill to avoid a government shutdown. So typically things that we would see that would typically lead to a stock market push and good news are still kind of it's not enough right now. It's not enough. And to your point, I mean, the talk of the town's tariffs. If you look at anything in the news, turn on anything about TV, it's all tariffs, tariffs, tariffs. And, if we look at trends on what the legacy media pushes and kind of the talking heads on TV, what they talk about, it typically is stuff that's going to be negative towards the Trump administration, regardless how it affects the country. And they're pushing that narrative right now harder than I've seen anything pushed before. And it's interesting to see how some of the pushback against it. I mean, when you look at tariffs right now, Chris, I was watching something earlier today, and they're saying it's more than just tariffs. I mean, there's multiple different things that are going on right now.
It's trade war, man. That's all it is.
It's trade wars, tariffs, but Trump's doing all this for a reason. I mean, one of the reasons he's trying to impose a lot of this is to fundamentally change the way that the economy operates, the way that the global economy operates. And if you look what he's also doing right now, he's really looking to push to reduce government spending. He's really trying to get that under control. I mean, we are right now running at about a $2 trillion a year federal deficit. I mean, not long ago, I can remember we were operating about a $400 billion deficit. And even then where people were like, oh, it's a deficit. Now we're talking true $2 trillion a year. We're over $36 trillion in debt as a nation right now. So to me, that's very, very important stuff. So when you look at that, though, why he's making these moves with tariffs, and then you look at not only reducing government spending, but also there's a lot of talk right now. He's really pushing to reduce income taxes for American. I mean, the latest proposal that Trump is talking about right now is to completely eliminate, the goal is to completely eliminate income taxes for people making under $150,000 a year. They've already put out there no tax tax on tips, no tax on Social Security, no tax on overtime. And now he's really pushing for no income tax on anybody making less than $150,000 a year. But if he wants to do that, if he wants to be able to reduce government spending, well, that's where those tariffs are really going to come in and making other people pay for this stuff. I mean, we've been basically giving the rest of the world a free lunch. We are the net purchasers of other people's goods by far greater than any nation out there. We buy everybody else's stuff. And the way that these tariffs work currently, we get no advantage to any of that. So Trump's trying to fundamentally change a lot of that. And, Trump came out, yesterday, 2 days ago, and said, hey, there's a transition period going on right now with the economy. It's very likely you just can't watch the stock market. Like, they basically saying, expect this stuff to happen. So
expect a correction is what he's saying. Literally, 100%. You are all watching this book unfold, The Art of War. Literally, like, you are seeing negotiating, tactics that we haven't seen in decades. And I hate to say it, but read this book or listen to this book. It's straight out of this. I mean, some would say, no, it's The Art of the Deal. Well, that's Trump's book. So yeah, probably is. But The Art of the Deal was largely inspired by The Art of War.
Right. And you said earlier when we opened up, Chris, that, are we already in a recession? And I mean, there was multiple times, over the last 3-4 years where it could have easily been declared a recession. Obviously, they didn't want to say that and kind of, faked a lot of numbers and a lot of updates, revisions later on and everything that's gone on, all the effery that happens. But at the end of the day, there's a downturn. Chris, you talk about all the time. We look at history, we look at, trends, we look at, the what goes on in the past. I mean, we've been due for a pullback, a recession, a huge, change for many years. It was about to happen before COVID hit. Obviously, COVID happened, completely changed the world, pumped trillions of dollars in the economy, created inflation, the highest in our lifetime and everything else. So this has been due for a long time. And regardless of the tariffs, what Trump's doing, I mean, we were going to see this happen. But what I like about all this is it's going to happen anyway. So while it's happening, why not fundamentally make changes to make America better into the future for our kids and our kids' kids, Chris? Because if not, this is just not a sustainable path that we're on right now.
I love some of the comments coming in from Instagram. We got KELNAKAZ. External revenue rather than internal will save everybody a lot on taxes in the long run. Notice how we said long run. That's absolutely correct. But will cause short-term issues. In other words, short-term pain, just like the administration said. In other words, a correction, a steep correction, but probably not a long recession. Okay. Because listen, a correction turns into a recession. You don't just all of a sudden snap your fingers and you're in a recession. Recession's definition, look it up if they don't change it again, but I doubt this administration will change it like the last one did. And then he goes on to say, keep overhead government lean so citizens hopefully won't have to support government any longer. Now, that's an interesting take because if you go back to pre-1913, there was no income tax. And the government, supported itself and things were happening too. We were fighting world wars and everything else. Like, it's just funny how we've become so reliant and so brainwashed to think that the only way out of this is income taxes. Now, I agree. And Ray Dalio, I just saw something. Now, Ray Dalio is he's no longer it seems as though he doesn't agree with what Trump's doing. Now, that's an interesting thing because I love Ray Dalio. And he's saying that the debt is the problem. He's literally calling out that the debt is the problem. But I'm not going to go against Dalio because that would be the dumbest thing in the world. I'm just going to challenge Dalio because he's sitting there saying China, is going to challenge the U.S., which it does seem like that's where we're coming. Everybody else is buckling. The Art of War. And who said it? Chris Ash, I believe, said something. It's astonishing how many countries rely on American consumer for their own prosperity. Like, that has become incredibly, incredibly evident. The Art of War playing out, like with China, or with not so much China, because China, it's not playing out altogether well. But just in the news, I thought I saw somewhere, and I could be wrong, where China was willing to have talks. Just a week or so ago, they said it's war. Essentially, we're willing to go to war at any cost. But now they're willing to talk. Canada, I mean, sort of just caving, but I mean, you kind of knew that was going to happen. And not only that, Mexico, EU. And now, the Zelensky and Ukraine supposedly coming to the table saying, hey, we want to talk about ceasefires. But I don't know if Putin's really, looking at it and saying, hey, I'm game. I think he's kind of cautiously looking at it. But, what you're seeing, like, is just something pretty amazing. You're finally seeing the world power called the United States of America digging its heels in and showing its dominance and showing how much the rest of the world relies on the United States of America, with the exception of several countries like maybe India and definitely Russia. Russia certainly, especially now, because we've pretty much made it so that they don't have anything to do with the U.S. Russia is pretty self-sustaining. China, I don't know. I don't know if China's self-sustaining or not. But we are definitely seeing the end of we are seeing the end of a world economy. We're definitely seeing geopolitics in a lot of the things that I read about in that book. The End of the World is just the beginning. We're seeing all this stuff come to light. I just didn't think it would happen this quickly. Chris Ash referenced a book called No Trade is Free, written by, I don't even know how to say it. Light, whatever. Sounds German. All right, Stephen, what else? I know we got a bunch of stuff to cover, and I don't want to keep going down these rabbit holes.
Yeah, I mean, is there something to pull up? I can get a little bit of the housing market. Unless there's something you wanted to pull up first.
No, housing market's fine. And then we can just talk about all, I think it's funny watching the news. We look at CNBC all the time. Not that we like CNBC, but it's just kind of comical to look at it. It's kind of just like whatever the flow of the market is determines what they put up there. Like this morning, Stephen, I was checking it, and all the futures were positive because of this new data that just came in, the inflation data. Okay, so the rate eased to 2.8. So the markets were all up. And all the news, and you just showed a bunch of them, was all positive, reinforcing things are okay, things are getting better. Look at all these new mortgages. Look at all this. But then when the market turns negative, what does the news do? It just flips to doom and gloom. It's just interesting how that plays out. And sometimes, like when the market does have these big corrections, like just any of the big corrections that happen in one day or a week, like how much of that is driven by literally fear-based panic created by the news? I don't know.
A lot. I would imagine quite
That's
a lot.
what I was looking to say, Chris. I guess I need another coffee. The end of globalization. That's just trying to spit that out. Super user said, Chris, what's your opinion? What's my opinion on what? Oh, the BRICS nations. Yeah, it's a thing to look at, but right now they don't have enough steam to ever rival the dollar. They just don't. They're I don't know, 5 years out to even being noticed. And with all the stuff Trump's doing, that's definitely going to stunt that all happening, because the U.S. dollar will remain the dominant currency of the world, given what's happening with these trade wars. I mean, make no two ways about it. Just keep watching. The U.S. dollar isn't going anywhere anytime soon. And the BRICS aren't going to come in and create a new currency that's going to take over and be what's traded. And also what you saw with the Middle East and what you saw with Saudi Arabia, I mean, they've pledged to put, how much was that, Stephen? Tens of billions, hundreds of billions, tens of billions of infrastructure into the U.S. because of this. You see, that's just what's going to happen. You're going to see all this industry and all this infrastructure come back to the U.S. because of these tariffs. But yet, if you watch CNN, God forbid you, I don't know what you're trying to do, just torture yourself, because you can't even listen to them because they don't let anybody talk. But an interesting thing about CNN is it's just tariffs are just all bad. But you're not seeing the other side. They're bad in the short run because it does increase prices. It will be inflationary. But in the long run, it is the path through. The obstacle is the way, and the tariffs are the way through it, because we got to create revenue some way, somehow. Unless all of you want your taxes to continue to go up, okay, and all of you want all these tax cuts that the Trump administration put in that are all sunsetting, if you just want them to go away, well then, hey, I don't know, man. I think you probably should just pack your bags and move to Canada. They're socialists up there. Okay, we're kind of a hybrid. Or why don't you try going to China? Check that out. See how you like that.
Yeah, good luck. I mean, the other thing tariffs do is, like you said, is they drive manufacturing. They drive people to to build here and to create products here, and that just creates a larger workforce. I mean, it creates a lot of new jobs. It creates a lot of new revenue and income, and it just but like you keep saying, there's going to be some short-term pain involved.
I think you definitely got to watch the BRICS, though. You know, can't take your eye off of them, but I don't think they are. But, you know, the headline news is just tariff. And it is interesting to watch the game that this administration is playing. And it's not really a game. It's just the art of war. But like to watch how all these other countries are just buckling and how fast it happens. It's just like they got no spines, but it's not even about spines. They just can't make it without the U.S. That's really what becomes perfectly evident when you watch this whole thing happen. They dig their heels in. They make all these threats. And then Trump's like, oh, okay. I'm going to increase your tariff to 50%. They're done.
Mm-hmm.
They're done. Like there's nothing they can do. Like that. When you play the trade war, you got to know who's got the cards, right? And the United States of America is holding the cards right now. They really are. So then there's always Jim Cramer. If you want really good stock advice, you can always watch Jim Cramer because he'll just tell you to keep putting money in the markets.
Yeah, I just saw something on.
I know. I saw it, Top Line News, CNBC.
So this was an interesting story coming out of the Wall Street Journal last week, talking about Biden's mortgage relief, quote unquote, relief fuels higher housing prices. It's created another subprime housing bubble and put taxpayers at risk. Wall Street Journal is calling for Trump to end the program. But, you know, why do housing prices keep climbing despite higher interest rates? The federal government has allowed borrowers to take out bigger mortgages than they can afford to prevent foreclosures. It's bailing them out when they miss payments. Behold another subprime housing bubble. So the problem began obviously a while back, but I'll kind of skip to the chase here. If we look at what's going on, FHA subprime bubble. So shares of borrowers with debt to income ratios greater than 43%. And if we look at since the year 2000, you can see how that number continued to rise. Of course, 2008 housing crash and kind of pulled back. And ever since then, you can kind of see what FHA has been doing, just giving more, especially since 2020, giving more and more and more of these not so hot loans out to borrowers. So as we all know, you know, these are the people that are typically going to be affected the most when there's a downturn, a recession. And so, you know, what's going to happen with all these mortgages out there when these people can no longer afford to pay because they were given loans that they couldn't afford in the first place. And so just another indicator of what might be coming here with housing. So about 7% of FHA mortgages issued last year went seriously delinquent, 90 or more days past due within 12 months. That's more than the 2008 peak already. So It's happening.
Well, in other news, we've got Porsche, owned by Volkswagen, coming out, going, kind of leaning into this whole trade war that is kind of really taking shape between the U.S. and Europe. And I guess I didn't see that. You know, Europe's always been an ally, but like, what have they ever, you know, it's kind of like a relationship where one of the parties puts nothing into the relationship and the other party keeps giving and giving and giving. Eventually that just comes to a head, right? Well, that's Europe and the US. We just keep giving, and we get nothing in return. Nothing in return. So kind of what they're saying now is, you know, they're talking about the Porsche business is largely like they're assembled and built in Europe. No two ways about it. But this is pretty interesting right here. The CEO, where is it here? They're going to make a massive investment into the US. And this is, I think, brand new news. Let's see. They're hoping for an agreement between Europe and the US. And actually, they're counting on that fair solution. But they also are, Volkswagen Group is investing over 15 billion euro in the US. So they're looking to put assembly plants in Chattanooga, Tennessee, and investments in South Carolina, which actually makes a ton of sense because if you really look at a lot of the auto in the U.S., tons of it is on the East Coast, you know, and you're going to see more and more of that. But again, it's just you're seeing this. Like these are giant corporations. Volkswagen's, I think, if I'm not mistaken, I think maybe Fiat's number one, but Volkswagen's one of the largest automobile conglomerates. I mean, they don't just own Volkswagen, they own Porsche, they own Bugatti, they own Lamborghini. There's so many cars that are part of this. Audi, Skoda, I don't even know that. Seat, no idea what that is. And Porsche, definitely know what that is. So all of those are owned by Volkswagen, and Volkswagen's got no way to play this game. Like they've got distribution here in the country, in the US, they got demand in the US, but they're manufacturing over in Europe. So if there's tariffs, the price goes up, and these cars, they're already not affordable cars. Like they all of a sudden now are just out of reach. So they got to move. They got to invest in the US.
Yeah, I mean, the trade war is heating up as we're sitting here right now, Chris. I mean, this is breaking news. Canada is imposing a 25% retaliatory tariff on $20 billion worth of U.S. goods in response to the steel and aluminum duties that took effect last night. So literally happening.
Just trade wars. But like, if you are running,
good luck to Canada.
And I know they got a new prime minister over there that just got elected. You know, and there's a lot of talk about how that's really not much better than Trudeau, but there really wasn't a lot of good choices to pick from. So when you look at that and you're kind of just saying, all right, what bargaining chip do they have to play with? Like seriously, Stephen, like what is Canada? No disrespect to our northern neighbors, but what is Canada as a country? Like, how are they going to like play this game? They definitely can't make it without the U.S. I'm sorry. I don't think they can. But yet they just keep playing this game. Like they're digging their heels in. I mean, kudos to them. Like, hey, listen, you know, like don't back down, like put a fight up. But I just can't see that ending well for them. I really don't.
Yeah, it's wild. Just real fast, we mentioned Jim Cramer. So this was Jim Cramer this morning. It's always entertaining.
Oh, they're pretty good.
So
we know that you have to do some buying because, well, it's been right since 1979. So I have to ask you something. Are you willing to bet that this time it's wrong? Alex said there's always a bull market somewhere. I promise I'll find it just for you. We know that you have to.
Sorry he talked a little fast there, but he said, if you sell here instead of buy, you're getting out when maybe you should start thinking about getting in. I say there's always a bull market somewhere. I promise you. So,
great advice, Kramer. Great advice. It plays right into his track history. I mean, just look it up. I mean, there's I think literally websites on Kramer's track history on what he's gotten right and what he's gotten wrong. If somebody can kind of do a research report on that and just compare the rights versus the wrongs, and I think you probably should take your advice from Nancy Pelosi. Anyway.
Yeah. He also came out last night and said Trump needs to change course, talking about the tariffs. The president should not ignore that scream because that's how you end up in a recession. And no kidding, Jim. That's kind of the point here.
Yeah, another input from Instagram. Kramer, who's the new prime minister, is full of it. And that's the resounding thing that we're hearing. Now, I know we're hearing it in the U.S. I'd like to hear what Canadian citizens are saying about Kramer. Is it a breath of fresh air? Are you excited?
Sorry, Carney.
Oh, what's that?
His name is Carney, Mark Carney.
Oh, I'm sorry. Yeah, got the wrong name. But we're just talking about Kramer. That's why.
Right.
Yeah. Anyway, this is good news here. Just saw this pop up. All right. See you in Dallas.
We should talk about Dallas because it's. I mean, everything going on right now.
It's super quick, and then we're going to talk about Dallas, Texas. China is willing to cooperate with the U.S. on fentanyl. So at least we're getting a start. All right. Let's talk a little bit about Dallas, Stephen.
Yeah, I mean, just the timing couldn't be better for this. We're bringing in so many different alternative investment experts. We're going to teach how to control your wealth, how to use real estate as a means to preserve when we're going through this recession. Opportunities that are out there, what to see, how to start saving more on the taxes that we are paying. I mean, Chris, when a recession hits, when we have an economic downturn, when things tighten up, like it seems we're on the track of happening right now, there's some things that everybody in the country should be doing. Would you agree with that when it comes to money?
1,000%. I mean, listen, there's going to be so many opportunities. Real estate pricing is already coming down. You're going to be able to buy so much cheaper, but like, where are you going to get the funding for it? Unless you're independently wealthy, where are you going to get the money from? Right. It ain't going to be the bank. And pretty soon, it's probably not going to be those Wall Street backed or hedge fund backed, private or not private, but hard money lenders or institutional lenders. So where are you going to go? Like, you're just going to let the opportunities go by?
Yeah, I mean, so now's the time to really get on the ball. I mean, there's some stuff leading up to this event too, and I'll get to this event in just a second. It's happening May 8th and 9th out in Dallas, Texas, and it's going to be a full day. So these times are wrong. We're going to go from early 8 a.m. Right through the evening, whether we're at dinner or doing something after. But just know that it's going to be full days, going to be there. We're going to hang out the night before on Wednesday evening. Just so everybody knows, we're doing a Thursday, Friday, because that is Mother's Day weekend, that Sunday. So we wanted to be able to get everyone out of there Saturday, get home to their moms, or the moms get home to their families. And so we're doing a Thursday, Friday this time around. So really excited for it. And, leading up to that, Chris, we're doing a wealth webinar, March Money Madness series right now, all about, looking at your money, what you can do right now to kind of prepare for what's coming, how to eliminate your debt. I mean, debt right now, if you have debt, like that should be your number one focus until you can just no longer pay off debt. Get rid of that stuff, because where you need to tighten up, it's going to be some tough times ahead. But to your point, Chris, when there's tough times, that's when it creates opportunities. And there's going to be so many opportunities. I mean, you look at that Wall Street Journal article, we look at delinquencies, we look at what's going on with the markets. So we're going to teach you how to take advantage of these situations, get into these opportunities, whether you're starting fresh, whether you're looking to preserve and grow wealth, whether you're looking to do something different. I mean, there's money to be made when there's economic uncertainty and volatility. We talked about in the stock market, that's your background, Chris. You make money in options trading when there's volatility. Same thing in real estate. You make money when there's a down market, and that's what we're approaching. So we're going to spend a couple days together in Dallas in May talking about that. What are those opportunities? Where can you put your money? How do you preserve? How do you grow wealth? No matter where you're starting right now, how do you access that money? And that's what Dallas is going to be all about. So if that sounds like something that might benefit you, do what you can to get to that event, because we are selling tickets right now. I think maybe we could put a discount code in for our What the F crowd, but just know that in 3 days, the prices are going up. So if I scroll down here, you can see right here, we have a little ticket timer. So prices are increasing in 3 days. So make sure you get in now, get your tickets, get your travel booked. We got a hotel block with discounted hotel. We're all staying right there at the same hotel. So it's just going to be a really, really fun event. Like always, the money tanks are always very, very successful. But I just feel like this one's so important right now because of the timing of everything. And I'll put some links over in the comments for everybody, but it's privatemoneyclub.com/money tank.
Yeah, I just threw it up over there, but you could put a link that actually works. I don't know how to do all that techie stuff. So lots going on. You could join us this afternoon, 1 p.m. Eastern, for the March Money Madness week number 2. And make sure you grab your tickets. I mean, what did you say? 4 days left, Stephen?
Yeah, 3.5.
3.5 days left on that. And I've been going live every single night on this same StreamYard. So all this, you've been probably hearing about, and I've been talking about lots of interesting things in the evening, but one of them has definitely been Money Tank, because in this new declining economy, this new correction zone, markets and possibly recession, there's going to be opportunities. There always is. It's why Warren Buffett's loading up on cash, and he's not alone. It's a bunch of the big smart money is loading up on cash. They're loading up on cash because it's going to be a feeding frenzy, blood in the streets. Like you've heard all Warren Buffett's quotes, when there's blood in the streets, that's when you get greedy. He's just right now, when others are greedy, be fearful. He's fearful. He's selling. He's putting money in cash, but he will get greedy again. And greed is not good, but I'm referencing Warren Buffett's quote because he wants to be able to buy cheap, and he's done it before. He'll do it again. You could copy him. You could follow along with him. You just got to get you got to get on the sidelines. You got to learn what to do, how to do. And even if you don't have your own money, you better get in Private Money Club. Can I say one more thing about Private Money Club that I think is super important? Whether it's Private Money Club's Money Tank out in Dallas or just going into the community, I hear it all the time. People are like, hey, I put a deal up. I put a deal up on Private Money Club, and I haven't gotten funded. I'm like, oh, okay. Well, what are you doing to promote your deal? Oh, I put it on the deals page. I said, okay, are you going in and searching all the bar or the lenders in there and trying to put, search functionality on there to see what lenders fit your particular deal so that they get notified? Because every time a deal goes up, you get notified. The lenders get notified if it's a deal that matches your criteria. Are you going in and talking to those lenders? Are you going in and, starting communications? Are you posting in the community? Are you bringing your deal to Money Club Monday if it's appropriate, if you're a premier member, because that's not available for free members anymore? What are you doing? Oh, no, I just put my deal on the deals page. Okay, so hold on a second. Here's what I want to say that I'm going to just say publicly, and if any of them are listening, you know who I'm talking to. So you go on Instagram and Facebook and TikTok, and you put a photo, a bio, and just a little information about yourself. And you just expect all the people on those social media channels to just seek you out, to just ask to be your friend, to start communicating with you. Oh my God, you just put a profile up. Oh, you are so awesome. Be my friend. Let's talk. Let's do business. Is that how it works? Because I'm clearly doing something wrong. Because when I put my photo and bio up on social media, no one asks to be my friend. No one talks to me. I got to go out there and I got to keep posting every day, consistently and persistent, and putting up stories. I got to go out there and comment on other people's stories and communicate with other members on there. They're not coming to me. I'm going to them. And then they're coming, looking at my stuff and saying, hey, I kind of like this. And I'm saying, hey, I kind of like your stuff. And then we're building a relationship. Although a social media relationship, we're communicating and I'm getting messages back and forth. That's how it works. So why would you ever think that privatemoneyclub.com would be any different? Because it is no different than any of the other social media sites, with one exception. You come to Private Money Club because you have money and want to make more, or because you need money, period. You come to Private Money Club to make money. You don't go to Facebook. You don't go to Instagram. You don't go to TikTok solely to make money. That's where PMC is different. And you know what the best part about PMC's Money Tank out in Dallas, the 8th and 9th, is you actually get to shake hands. You get to have a cocktail with them. You get to have dinner with them. You get to meet and have discussions with them and present your deal to them in person. Just imagine if Instagram did an event where all the Instagram members just met at this one event and you got to meet all the people that you only see posting on there. How many people would show up to that event? Yeah. So that's what Private Money Club's Money Tank is. It's a meeting, a relationship building, and more deals get funded at Private Money Club's Money Tanks than any other place out there. So you need money or you got money? That's where you need to be. 3.5 days left. Get your tickets. Sorry to ram this down your throat, but like seriously, like what are you waiting for? Justin's not waiting anymore. He's got my ticket. Fern's not waiting anymore. Got my ticket. Chris Ash is asking, are there virtual tickets? 100%. You can definitely get virtual tickets, but we're not selling those yet. Okay. We're trying to sell actual tickets, but pretty soon you'll be able to get virtual tickets. Okay. So you can watch it from the comfort of your home, just like this. All right, let's bring this thing home.
Real fast, Chris, just on that. I mean, you know, obviously I'm very involved with Private Money Club and talk to our members, run webinars every single week. And, you know, a lot of people do kind of feel like it's almost like infinite banking, where if you're familiar with infinite banking, you guys all know this. It's not about the product, which is the whole life policy. It's about the process of being your own banker and being a practitioner of the infinite banking concept and how you use that whole life in your life to move money and to grow wealth. And that's the power of it. And Private Money Club is very similar because PMC.com, the platform, privatemoneyclub.com, that is the product essentially. That's where you can go, you can post your deal, you can do things, but that's not going to make you successful, you know, just that alone. It's about the process. And in business, investing, real estate especially, success comes in relationships. And that's where the power of Private Money Club comes, because you have people on there with the right mindset, with this right attitudes, with the same common goals that are meeting on PMC and kind of exploring each other and feeling each other out. But then they're connecting and making those deals happen through the relationships. And those borrowers that come on Money Club Mondays, that are on our 2-hour premier member only group mastermind call every single week or every single month, which by the way is next Thursday evening, that come to the live events, Money Tank, that people see them. Those are the ones that get a deal. They need $500,000 today. Guess what? They're getting that deal funded tomorrow. Why? Because they put in the time to build those relationships. Now they have that Rolodex. They have those people that they can go to, and they make things happen fast. So get to the event, show up, be there if you're serious about this. Now, as a lender, it's a little bit easier because as a lender, you can go on and you can start finding what you need, finding what fits your investing goals and strategies and make things happen. But those bars, you got to be on to build those relationships. It makes a huge, huge difference.
Agree. 100% agree. So folks, decision's yours, you know, but you can just join us today, totally free for March Money Madness. We're always putting free content out. That's not changing, but to get behind the closed doors where the real good is being done, the real getting is being had, you got to show up, folks. You got to show up. All right. What do we got? What do we want to do to bring this home? I think the sum up of this whole thing is the same as it's been for a while. It's time to really get serious about what you're doing with your money. It's time to really start getting prepped for what's about to happen and what's coming, because it's pretty evident where we're going. I don't think we can have any more conclusive evidence and conclusive data showing you the direction we're headed. It's going to be some short-term pain, folks. There's going to be blood in the streets. Are you the one shedding the blood, or are you the one taking advantage of it? And I don't mean to use that reference of blood, but that's what Warren Buffett says. So get used to it. Get ready for it. It's no longer so much a discussion of know when to hold them or fold them. I think you already know. You should have already folded them and got ready. Oh, and by the way, you're still getting paid quite well to sit on the sidelines, because the Fed has not dropped rates. So therefore, your high yield savings, your CDs, your fixed annuities, your safe money is still getting a good return. And if you want an even better return, now would be the time to start looking at long-term treasuries. Not making investment recommendations or advice, but I'm just saying, get your butt looking at long-term treasury bonds, because you know what? It's already happening. And if you don't know what that is, check out my YouTube channel. Watch the videos I put up there teaching you the inverse relationships to interest rates and treasury, long-term treasury pricing. With that being said, folks, thanks for joining us for another week of What the F Happened. We'll see you this afternoon at 1 p.m. and again later today for Ask Me Anything Happy Hour, which starts at 4:30 Eastern. Till then.